We will kick off proceedings with an overview of investment markets and the prospects for the rest of the year. We have seen significant volatility during the first 3 months, and there is currently a lot of noise in the market. So it is not easy to identify clear signals of where markets are going. I have two panelists to assist with this discussion. Joseph Busha, he's the Chief Investment Officer of Busha Investments, and Tshepo Modiba, he's the Chief Investment Officer of Cannon Asset Managers. Tshepo, thank you so much for joining us this morning. Let's start off with noise and signals, because we see investment markets on a good day move 1.5%, 2%. On a bad day, it can be a lot more than that. We've seen some 3% plus movements over the past 3 months or so. So how do you distill signals from the noise? What are you looking for to try and gauge where markets are going?
Good morning, Rick. I think markets are almost inherently a contradiction, right? We're taught as investors to pay attention to all the information coming out, but you can drown yourself in a lot of that information. I think the important bit is to focus on the drivers of why you take investment decisions. As an investment firm, we spend a lot of time looking at valuations and fundamentals of businesses. So what we're always trying to discern is whether the news coming out really changes our investment thesis on either the market as a whole or individual stocks. And I think that's the key component in remaining sane and not fluctuating as the market fluctuates.
Sane, it's an interesting term. But Joseph, in the past we would value companies based on future performance or expected future performance, and there are many very financial, focused models to do that. Is that still the case at the moment, or does the geopolitical developments and the monetary policy type of movements we are seeing, does that affect it maybe more than in the past?
Well, certainly you just mentioned some of the key points, really. 40 years ago, or in the 60s, there were very few variables that would determine where the market is going. So currently you've got the geopolitical issues that come into it, then you've got country risk, a specific kind of risk that comes into it, and obviously the fundamentals. Now, your MPCs or central banks today, they play a massive role in terms of determination of valuations and where they're going, because they make decisions on interest rates, and some of them obviously inflation. So then they've got a dual purpose in terms of the monetary policy and certainly where inflation and interest rates go. So those really certainly play a massive role, and you'll be able to see that over the last 10 years, how geopolitical events, politics, the noise comes into it. If you're doing your studies, the issues where you say you must do SWOT analysis and PESTEL, which talks about political legislation and so on. So those really are coming into effect. And you have seen it, with the Russia-Ukraine issue. That's massive geopolitical factor that brings in the volatility you talked about. If you just look in terms of the volatility since the COVID, we have remained quite high. In terms of volatility, but also when you just look in terms of the volume of equities traded on the JSE, you can pretty much see the trend in terms of the fear and the behavioral finance coming into play as well.
I don't want to get to emotion, and I'm sure during this conference we're going to hear from several different speakers that keep emotion out of investment decisions. But the swings we are seeing, I think, are partly, if not significantly, impacted by emotion by professional investors, because we are seeing significant volumes on many markets around the world. Is it a nervous market which causes this? And how do professional investors look at these developments? They see the market up or down 4%. Does that influence you? And how do you take emotion out of it?
I'll keep going and be the boring traditional investor. I think ultimately what you want to try and do is have an investment thesis, a basis of that. And you touched on a little bit about how perhaps how we assess valuations has changed now relative to before. I would say actually this period, we've seen periods like this before in financial markets, the 70s. Investors who've been around since then talk a lot about how the 70s unfolded, particularly in the US market. I think for emerging market investors in particular, we're sort of accustomed to volatility. But I will further say that I think it's important to try and block out the noise and keep focused on why you're buying. Is there something fundamentally that's changed on a day-to-day basis that changes that?
Are you trading in your funds more often than you did 5, 6, 7 years ago?
No, we aren't. I think the fundamentals of businesses aren't changing as frequently as the market sentiment and movements. I think it's really important to keep a hold of your emotions. What I will say is not the day-to-day movements, but the significant market changes where the market either rallies 30-odd% over a couple months or it drops down significantly, as we've seen in pockets of last year, do present interesting opportunities. I think there's stocks that we've added to our portfolio that certainly I didn't think that we'd get an opportunity to, just given how much they had rallied before.
Joseph, you've been in the market a long time. You're a very experienced fund manager. Has your trading behavior changed, say, compared to a decade or so ago?
So certainly, I think you do have a long-term, your long-term view and your long-term strategy. And when you do an investment, it's based on valuations in terms of obviously the long-term. But when you change your portfolio in terms of whether at stock level or asset level, you capture the mispricing that happens. But if you then say what has changed over the last few years, I mean, I remember trading at the JSE in the 90s when I was at Diagonal. What would be the drivers then? Could you just look at trend analysis? Could you just look at interest rates or the MPC? But also, we must accept as investors that the way of business is changing because of technology and AI. So if you're not going to look at big data, artificial intelligence, if you're not going to look at the disruptions that has been brought in by technology, if you are a financial service business like a bank, now you must understand, or insurer, you must understand that the mobile providers, cell phone providers, are also doing financials. They're in insurance, they are in banking, and so on. So you gotta be able to say your income streams, okay? How are they changing? How are you diversifying to be able to make sure that you can still remain relevant and compete? So the way you communicate, there's now WhatsApp, there's Facebook, there's Instagram, something like that. So there are different ways of marketing. There are different ways of where business models are changing. In the past, you would look at, my favorites was like Omnia, Sanlam, where you call them defensive stocks, right? Okay, but is it relevant now? So if you look in terms of Sanlam, from a share price perspective, it has remained really kind of stuck, between 50 and 60 for a very long time. But you could say possibly, it will give you the dividends you want to get, but you might not get a lot of capital gains. So there are a few changes. You need to be able to change. But also the investment horizon, people would focus for 10 years, but now you need to look at a shorter term, possibly 5 years, to be able to determine your terminal values, for your equity valuation, to say what is the enterprise value of the business. So you can't go long term any longer, purely because it's now more difficult to determine the interest rates which you use to discount the cash flows, to get your valuations.
So it's a lot more difficult today than 10 years ago.
It is, because your factors that are changing, both quantitative and qualitative, are more complex. you look at volatility, you look at the optionality that's coming through to change some of your stocks, and really just a question of the globalization as well. So your currency risk right now, if you invest in offshore, okay, that also becomes big in terms of currency translation. And also the fact that the companies are now global. So you earning money in the US in dollars and in euro and in rands. So when you do your financials, you do your currency translation. At what rate do you do and what do you use? So those things really are making the investment market a little bit more complicated, but certainly experience then comes in to say, well, here is your long-term view. This is the reason, like Tshepo said, why you entered into a particular stock, but you have to look at changing circumstances, to be able to say, well, the fundamentals are still the same, but because of the dip, I still like the share, let me buy more. So the noise, so you make money out of the noise, mispricing, and mispricing comes out of noise.
Let's talk about cycles. We are in the midst of monetary policy tightening cycle, not only in South Africa, but also around the world, and it has had a significant impact. But there are also investment cycles. So let's get into a helicopter. Let's go up as high as we can and look down at investment markets, and it's a broad term because many of the markets are correlated. Where are we in the current investment cycle? And I know it's a difficult question, but if you take the 5 to 10 year view, how do you foresee markets adapting to what is happening, for example, in the monetary policy arena?
I think it's quite a broad discussion point. I think there'll be sub-cycles within the broader market movements. One of the key themes, I think, going forward will be the divergent performances of different commodities, right? We know specifically commodities like copper and nickel, there's going to be a ramp up in demand as the world shifts to electric vehicles, as an example. Just as an illustration of that point, between 1 and 2 kilograms worth of nickel is used in internal combustion engines, and between 40 and 60 kilograms are used in electric vehicles. So if we're moving to a world where half of the vehicles produced are going to be electric vehicles, that gives you a sense of the likely ramp up in demand for nickel. Copper quite similarly. The outlook for platinum is different, given the reduction in internal combustion engines, but that will be a function of the take-up in hydrogen as an alternative technology.
Commodities, you think, would be supported with these developments?
I think some commodities will be, and I think I think where we are in the world is there'll be a big divergence across sectors, across individual counters within those sectors as we go along. I think what we've seen for the better part of the last decade and a bit is a general thematic investing has done well, right? If you invest broadly in the large tech companies, you're riding the wave and you're doing well from that. I think the big theme will be individual companies, individual sectors doing better than others. And I think that will be a dominant thing. In terms of an overall market view, we're relatively bullish on the outlook for equities, locally as well. I think local markets from a valuation perspective are looking attractive relative to a lot of markets around the world. We're quite bullish on emerging markets, South America in particular. And we think it'll be a bumpy ride. But certainly, if you can put your seatbelt on, you'll survive that ride through the cycle.
Yeah, absolutely. You need a gum guard in these markets. Your perspectives on the cycle?
So we have just come out of the lowest interest rate environment in 40 years in many countries. before the tightening cycle started now, and it was driven purely because of inflation that was getting out of control. We're still kind of in the tightening cycle. And you know, once that is the situation, there's obviously an asset allocation shift between fixed income instruments or investments, securities, and equities. Now the movement then would be, you know, how much are you moving from fixed income to equities? But within the equities also there are sectors in terms of cycles, you know, where, you know, are we in a kind of in a bull run kind of cycle, and in which sector? Now you have the commodity sector or the resource sector. Then you've got the industrial, and then tech and financial, which I'll just kind of group together, you know, to say, you know, if we look in terms of the cycles, you know, where are people shifting and in which cycle? Also, if you look in terms of, you know, the global corrections that has happened, whether you can call them crashes, you know, on average, every 6 years, you kind of get a little bit of noise and the market kind of bumps.
A reset,
Yes, okay. So if I just go back when I was at the JSE as well, you look in terms of 97 during the rubble crisis, then followed by, you know, some few years, 2001, 2003, the Iraq War, then 2008, and obviously just now a little bit of the COVID. So cycles, you know, you can't time them, but certainly there's a period, you know, where you kind of shift and move towards as people move from one asset class to another, and shift to just make sure that there's smoothing out of performance, and you really don't get out of kilt into that. So currently, I think there's a little bit of shift into the fixed income. I think this year might end up like last year, where we're pretty much flat. If you saw in 2022, so we ramped up from 2020 to 2021, where the equity market almost recovered 40%. Then between last year to 2022, October pretty much flat, and then we had quite a nice pickup this year when the JSE reached, you know, all-time high. But now we basically possibly down from there. You know, in the first quarter we'll be certainly down. So America is going to take you know, lead the world markets in terms of where we're going, in particular in interest rates cycle.
But we are close to the top of the interest rate cycle.
We are certainly close to that. It's a question of now just managing. But remember, now we still have the geopolitical issues. Then on the domestic side, we still have constraints in terms of manufacturing sector and all the sectors in terms of the electricity shortages, which is really just hampering in terms of the outlook for economic growth. We do have also issues of unrest, you know, in France, people striking, all those things really.
No, we don't have a monopoly on that.
And in SA, our biggest challenge is municipalities, because there's no leadership. So would that lead to unrest and further disturbances, or in terms of, you know, the economic activities, in particular the retail sector? So I think those are all things, but I'm not basically very bullish. Only when the interest rate cycle kind of tops up and we see inflation coming down, people start moving basically into equities from fixed income after they've just fixed their portfolios. And the sectors really to look at possible to be resources and financials.
Yeah, I agree. I think once I don't know if we will ever have certainty. I think the word uncertainty is overused, but I think when interest rates, if that cycle turns, yes, it could be very positive for equities.
I think that is the historical trend. What I will say is, if you look at the US market in particular, it's not so much that we need interest rates to start being cut. You need a stability in interest rates. And given that curve is flattening, I think we are closer to that point than many realize.
Let's talk about valuations.
Yeah, it cannot be flattening, because I mean, if you've been getting yields coming up, you know, was the yield curve normal? Are we getting it into a bump in the shorter end where the yield curve is shifting? So it depends where it pivots really, you know, because if you are increasing your short term and your long term is going up, so it must start normalizing again as they start cutting. So that basically depends where the point of inflection is. and where people then reposition. But remember also the U.S., we have elections coming next year, and Mr. Trump has thrown his name in the hat, and we're not quite sure also how that will play out in terms of just basically market sentiment. We cannot take out sentiment, and certainly your leading figures in the investment world where they put their money. But I think all of us, if we're to learn from Warren Buffett, certainly, obviously, you're riding the wave over the long term does help. But I think we still, like you said earlier on, there's still some bumpy issues, and we need firm decisions, both from central banks' perspective, but also the political leaders.
But you say firm decisions. My perception is that there is almost a brutality in the way the Fed approached inflation. It's been a very, very aggressive response. Is that what you're referring to?
Well, they wanted to tame, but you see, when I talk about basically following fundamentals, is to basically remove emotions and say, how do we tame the market? In other words, how do we control the market? Because we still continue to see lots of pumping of money into the financial market, with Credit Suisse coming down and SBV coming down as well. You see that there's just been lots of money that is being pumped in, but American jobs are being lost as well. You of course few guys who have been shedding jobs. In particular, last quarter and this year. So I think, they need to make a decision to say they don't want the market to overborrow by being very aggressive, which is what you just said. You've also seen that they started increasing by 25 basis points, but certainly I think if they do increase again by 25 basis points, it might reach a boiling point. So they need to basically look into that and start toning down in terms of their rhetoric.
You've raised the issue of banks. We've seen some action in the US, a very, very significant reaction, negative reaction stemming from that. We have recovered from it somehow because I think the short-term problem has been addressed. But then we have Credit Suisse. There are concerns about Deutsche Bank. And the financial sector is so critical to markets. I think you can have problems in many other sectors and you won't have this reaction. Banks, they are the cornerstone of virtually every economy, if not every economy in the world. What are your perceptions about what happened now, the market reaction, and do you think this crisis, in quotation marks, has been averted?
I'll just touch quickly on your comment around Deutsche Bank. It's funny how emotion and sentiment helps drive fears. So the concern with Deutsche Bank is because the CEO came out to say everything's okay.
Every bank says that.
And everybody panicked. What do you mean everything is okay? I think if we take a step back, one of the key curse words, of course, in investors' minds across the globe and business mind is regulation, right? But I think this banking crisis that we've seen as a function of what happens when regulations aren't put in place. So the key driver for what happened with SBV is, of course, there was a relaxation of compliance with regulation for banks under a certain size in the US. That enabled the management team to then take more aggressive bets in terms of their deposit book and where they invested, and we're seeing the consequence of that. I think from a banking perspective and investing in banks, ultimately confidence is crucial, and those markets where the regulation is very clear, and at some points we complain about how stringent it is, have managed to preserve depositor money over the years. So the likes of South Africa, Brazil, and a few of those markets where indeed the banking sector is actually quite deliberate around how they enforce those rules, have managed to keep stability in those sectors. And I think as an investor, it's an important thing to keep considering, that regulation isn't inherently good or bad. It's just to assess whether it's the right regulation for a particular sector.
Well, regulation is good, so there's no way that's inherently good or bad. Regulation should be good, and I think it's important to have regulated entities, purely because the behavioral issue we talk about and greed. So when looking in terms of regulation is a moving target, okay? Because businesses are trying to innovate and get competitive advantage, and the regulators have to respond, okay, to new trends and to new products that are happening. So regulation is not static, is something that is dynamic and is led by basically businesses, because the financial service sector has been kind of challenged by the cryptocurrency and other issues coming into the market, into our social lives. So they have to respond to that, to say, how do you deal with a business that say, well, I'm not dealing only with Bitcoin, and how do you also deal with a bank that focuses possibly on a niche of venture capital or kind of startups, and those startups are going to be innovative.
Yeah, it was actually quite ironic. Just after Silicon Valley Bank had its problems, some commentators said, listen, there's been a move to crypto because it's seen as a safer asset class, going from banks to crypto. But let's talk about valuations. Let's look maybe at two markets, the JSE or local markets and the US. Where do you see valuations? Is it high, low? How would you describe it?
I think, let me start with the JSE. I certainly don't think we're at valuation levels that we haven't seen before. This certainly isn't the early 2009 where valuations were at the lowest points that we'd seen over the course of the last 30 or 40 years. But I would say that given long-term trends, valuations are attractive, broadly speaking. And I think they're implying that over the next 3 to 5 years, we are likely to see good, not exceptional, but good returns coming out of the JSE. The US picture is a little bit different. If you look at the US historically, or certainly in the course of the last 30 or 40 years, valuations haven't always been a great indicator of when the US market is going to do well or not. And I think that part of that is the type of companies that have driven those valuations over the last decade or so have been tech firms that have had really stretch valuations from traditional measures. I think because of that, the picture is a little bit more opaque in the US, and in assessing that market, one has to be a little bit more discerning. Interestingly enough, I do think that the reaction to the FANGs has been such that there's opportunities in that space now.
Joseph?
The US is always going to be a driver. I mean, if in terms of the fourth industrial revolution and where we are now, you're not going to be able to ignore the US. So if you look in terms of the big tech companies that has been there, they would either compete, one-on-one with Chinese companies, where they talk about Tencent and the Amazons and all the different businesses. So the US dollar is also still the global currency of choice, reserve choice. So I believe that the US certainly is still quite significant, and that's the reason why, South African authorities increased the exposure you can take offshore, is to try and take advantage of that, in spreading country risk. And playing into the safer hard currencies. So currencies are going to play a big role. The rand is 1820, or between 18 and 1850, don't know where it is now. That is pretty weak, and you also need to say, how do you play with that? So my view is that, your sectorial focus is going to be very critical. We had our resource stocks kind of being hammered from about 2012, 15, 18, and then came in banks that did very well. And in the last 1 year or two, it has been resources, where profits were, it doubles, and headline earnings per share, EPS, all doubles. So there are opportunities. I'll give them almost pretty much a 50-50.
That's sitting on the fence.
So you wanted to be more specific. So there are certain company specifics, companies in SA, I think that would do very well. So you would certainly, possibly put more into SA than overseas. I would possibly allocate 60%.
60?
To SA and 40 outside.
If I can add to that, if you're looking at a US versus a relative assessment of everywhere else in the world, I would say the US naturally, as you touched on, is a big driver of the world. There will always be opportunities there. But I would be underweighting the US relative to its benchmarks versus other opportunities in the world.
I would like to hear from viewers. Please send your questions to events@moneyweb.co.za, or if you're on the YouTube channel, there's a chat box. Just type it in there and I will post it to the panel. Correlation. In the past, the JSE was really correlated with what was happening in the US. That seems to have disappeared, partly over the past few years due to the performance of the tech stocks in the US. We didn't really follow suit, and obviously that is a pretty significant reason. But do you foresee a normalization of the correlation, or are we becoming more like other emerging markets where local factors play a more important role?
But before we go there, if you don't mind, if you can just look into this. I think the last point where we agree that the US certainly will be vital was to be quite important, significant. What's happening in the European Union, in the EU, do you think it has a kind of an impact in terms of how then where investors put their money? Purely because the EU, there's no leadership. After Brexit, I think things are just looking a little bit sour in there. Do you think then that gives investors more room just to be leaning towards the US?
I think in general, if you take a step back from a geopolitical landscape perspective, we think the world is going through a period of what we call multipolarity, right? So if you look back at the history of the world, we go through cycles where there's one dominant superpower. And in those periods, we have an increase in globalization as the world is optimizing who produces what. You have low inflation environment in those periods, and actually relatively minimal conflict because the big superpower is the judge, jury, and executor who gets to make assessments on who's right or wrong. I think where we are in the world right now is not that period. The US has lost its prominence in terms of its geopolitical stature. And what that's meant is that regionally, more and more countries are focused in their own internal politics. And that's what we're seeing throughout Europe, where there's a rise in each country looking at focusing on what's happening domestically rather than this unified, broad European stance. And I think that trend is likely to continue for the next couple of years. And I think that's what's driving the internal conflict that we're seeing.
What will happen in Europe if the war ends tomorrow?
Russia-Ukraine war?
Yes.
I guess the question is, how does the war end? I think that will have a bearing on what happens. Certainly, what's helped economically has been a relatively warm winter. That's meant that the economic performance coming out of Europe hasn't been as dire as we anticipated, which certainly from a South Africa perspective has helped. Europe is still our biggest trading partner. But we can't bank on that for another year. So I think some sort of resolution of the conflict in the next year or so would be ideal in terms of setting the scene of what's going to happen in Europe going forward.
Anyway, so basically, China has been the global economic superpower over a long period. People didn't actually not realize that China is the center of mass production, superpower. So America has been superpower from innovation and I guess military, but certainly China has always been, at least for the last 10 years, the global manufacturing superpower or provider of goods and services. But let's go back to the correlation. I think a theme you introduced. So the correlation, purely because of the way I think investors look at things, there's always going to be correlation, and also because of, say, if you look in terms of our market, if I can just zoom in onto that, what's the correlation between the different sectors to the overall market? It's purely because of how the indices are constructed. And so you have to remove the correlation out of that, to be able to really see, how the markets are going. And that's a very complex kind of statistical process because you will certainly see that there's autocorrelation in almost every sector because you need to remove that sector from the overall market to then say how correlated it is, in terms of influence. So that would be massive. It's purely because of the benchmarking we do. So you either benchmark your returns on your domestic currency versus the US dollar, and you use obviously the global indices, your MSCI indices, to be able to confirm, in terms of how your portfolios are doing. So I believe that, there won't be significant divergence, so to speak, in terms of the global indices because of what I can say, the composition or how they are constituted.
If I can,
yes, please.
I think what's driven the decoupling of South Africa's performance relative to the rest of the world has been, a lot of it has been driven by internal factors, right? We know what the state of electricity is. We know some of the mishaps from a policy perspective that have driven that. I think what we need to see in terms of the local environment is load shedding, government getting a handle on that, Transnet getting a handle on that. And I think sorting out those local factors will then likely return us to an environment where we perform in pockets in line with what the rest of the world does. I think ultimately because the South African market is as liquid as it is, it's almost a proxy for risk always. If you sort out local environments in a risk-on environment, the world will filter through in terms of flow.
But many South Africans are very, very negative at the moment. We see business confidence levels at record lows, consumer confidence, investor confidence as well. And that brings me back to the emotional, the debate about emotions. You said you are 60% local market and a 40% foreign exposure, that you believe that is a good split. What are your views? Because there is many views that says, listen, there are too many risks in South Africa. Get your money into a stable economy. You will probably see some growth, but it's mostly a decision to protect yourself against potential problems in South Africa and a weakening exchange rate.
If we put on our investor hat, I think it's important in making investment decisions, you can't just focus on the asset side of things. What you really need to assess is where are your liabilities. For most investors, whether large institutions, for individuals, most of our liabilities are in rands in South Africa. And that dictates that the lion's share of your assets need to be invested locally.
What is a lion's share?
No, I mean, I think the majority of your assets need to be invested locally, because ultimately, if most of your assets are invested offshore and the rand goes from 18 to 12, that then means that you are losing a significant share or ability to cover your rand-based expenses, mortgage coverages, whatever the case is. So I think from that perspective, we need to always think through where are your liabilities based in that investment decision making.
But is that a retirement perspective? Or what about somebody like me? I'm still young, I may have grey hair, but I've got 20, 30 years of investment time in front of me.
Sure, but you still, without knowing your particular dynamics, you still maybe pay a bond here, you still pay school fees, hospital cover, all of that needs to be matched in rands. If you've got a basis that where those things are covered from a cash flow, then you can make the optimum upside decision. I do think from a relative valuation perspective, the South African market is in the top 10 most attractive markets in the world. And I think then the case is being discerning around which companies. We do have a lot of issues domestically. Some of the commodity players are exciting opportunities. I do think the likes of MTN, to mention a stock, is companies that are undervalued and are ticking a lot of the boxes that we want. A company that's showing innovation, going into new industries, but covers a lot of your local liabilities.
1 minute, please.
So basically, when you talk about performance, there's the economic performance, which is different from the capital markets performance. So sometimes we need to look at those two things differently. That the economy might not be doing well, because of the load shedding and some of our constraints. But also when you look in terms of the market, just adding towards we all kind of saying that South Africa could still look attractive. But some of the stocks like your Naspers, some of the heavyweight stocks in the top 40 are global stocks anyway.
Yeah. Okay. Well, this has been a fascinating discussion. Thank you, gentlemen. I think we can talk for the whole day about markets. I'm sure we're going to talk during the rest of this program about stock picking and to see where there is value. There are many opportunities, many value traps, and I think the uncertainty, and there I use the term, is going to be significant, and it will be an investment theme going forward.